Again, I sound like a broken record. Since Halloween, basically, it's been very bullish, and the flows this week show that again. There's been a couple blippy type days recently, but the low volume in SPY and overall, and the inflows to me says this will be short-lived, but we'll see. You can see here from the weekly inflows, SPY, the Qs, that's small caps. You've got discretionary. You've got retail. That's a retail S&P. You've even got junk bonds. So it's really a who's who of risk on. This one strikes out to me. This is VEA. This is international developed. Remember, we have not seen international really come on the leaderboard hardly at all, but they are making a comeback. Let's look at that. Let's look at international developed versus emerging markets over this past year, and you can see it's been bad. So they're just now positive for international developed, and we're seeing money into small cap growth value, so it's spread around in that EFA area. Now let's also drill down even further and look at Asia and Europe as regions and the countries in there, and you're also seeing that. Now, this is the zero line, so these plays have been beat up this year, but they are starting to see bids. A big one is EWJ. The Japan ETF has taken in $1.2 billion in the past 6 weeks, and we've also seen a ton of money into some of the European region ETFs. So, Scarlet, look, there's a lot of interest in risk right now, whether it's the U.S., which we know is doing good, but also internationally.
Yeah, that's the money is starting to rotate a little bit here. All right, let's bring in Doug Yones. He is head of exchange-traded products for NYSE Group, and we also want to bring in Carolina Wilson, who focuses on emerging markets for Bloomberg News. Doug, great to see you.
Thanks for having me.
So U.S. equities clearly the star performers over the last few years, but we're starting to see interest in international markets, and there are all kinds of calls that international will outperform the U.S. in 2020. What are you seeing? What are you hearing at the NYSE?
Yeah, we're seeing both the liquidity, the trading of the ETFs, and also the cash flows. Almost $14 billion in international equity ETFs this year, but the big story has been fixed income. Surprises a lot of people. Almost $18 billion in net cash flow in international fixed income ETFs year to date. So it's really been a big fixed income play.
All right, so international either way, whether it's equities or fixed income. Carolina, the global story, of course, depends a lot on how trade plays out, and we don't know what's going to happen. Some, though, would say that perhaps some of the easy gains have already been made.
I think that's true. And when we look at emerging market ETF flows, Trump trade headlines continue to be that sort of dominating sentiment driver. On one hand, like Eric pointed out, we've seen EM ETFs taking 8 consecutive weeks of inflows, really strong winning streak there for that category as that December 15th tariff deadline nears. But on the other hand, we've seen that surge of inflows, I'll have to say, slow down a bit, as I think investors are exercising caution at year end, afraid to add too much risk, especially because they don't likely want to compromise year-to-date returns. And you have to see the volatility in some of these regions. Yes, Chinese equities make up that most of that chunky exposure for broad EM funds, but look at the volatility that has erupted in Latin America and Brazil and Argentina and Chile, for example. Investors also pay attention to those idiosyncratic stories, and I think it makes them a little more risk averse.
As well they should. A big theme for next year, of course, Eric, is the arrival of active ETFs that don't always disclose their holdings. Rachel Evans of Bloomberg News has come up with the best acronym here, ANTS, which are active non-transparent funds.
Yeah, this is all us analysts are interested in this, but regular people should be too, because trillions of dollars are licensing these structures that are active. So a lot of big managers are probably going to use them. Can you handicap the race and just talk about from a trading point of view how this will look to the end investor?
Yeah, I mean, if we fast forward, and what we're really doing right now is we're planting a forest, right? So we're going to add a lot of trees. It's going to take a few years, I think, till these trees flourish. But at the end of the day, at the end investor is going to see them as an ETF, exchange traded fund. Are they an active strategy? Are they a passive strategy? How they invest, that's fine. But I think we can get into the deep wrapper. But at the end of the day, they're really about ETFs. And what does ETFs provide? They provide intraday liquidity. They provide a little bit more tax efficiency. And they provide a wrapper that, frankly, is less expensive for the manager. And so if the active manager can remove 50 to 75 basis points of cost out of the investment vehicle they're providing, us as end investors, we win. Right? We can dramatically reduce the cost of investing. And for the buy and hold investor, year over year, that's a lot of savings that go back into performance.
Absolutely, 70 to 75 basis points, definitely. Carolina, there's a certain irony here, though, that most of the active non-transparent ETFs will be for large cap equities, where there's not a lot of inefficiencies to exploit. They should be in small and mid caps, where there's a lot more room for an edge, for an active manager to find an edge.
Or even in EM or international markets. I mean, it's in those niche areas where active really does get to shine. And so in a sense, where active can be competitive, that the approval for that structure doesn't currently exist. I think the hope is that it will expand eventually to include some of those more international facing strategies once the structure has proven itself in terms of with these more liquid U.S. stocks. But the idea is also that with EM and international markets, that's where we tend to see more spreads, right? So it's also a little more difficult because that arbitrage mechanism, maybe there's concern there on execution.
Now, Doug, you're working with one of them, Natixis, I believe is how you say it. They've got one of these in the ant race, so to speak. Are there going to be any issues with you? You know, you're the exchange sponsoring one. Are the others going to be like treated fairly, basically?
There's no sponsorship happening at the exchange level. We're doing what we do best, right? We're providing a location for liquidity. So regardless of what the structure an asset manager wants to use, whether they use the Presidian model, whether they use the application the New York Stock Exchange has, or whether they use Blue Tracker model, at the end of the day, the exchange is there about providing liquidity and providing a marketplace for these structures to basically flourish. The key piece that's important is the way that the SEC approval process has occurred is now basically any domestic equity security. So we talked about mid cap, we talked about small cap. All of those securities are now eligible for these structures. So a lot of active managers are thinking, how can I put an active mid cap fund? How can I use a small cap fund? And we think international is coming quickly thereafter.